What I want to do is I want to switch gears for a minute, and I want to go through several charts this morning very quickly. We have a lot to cover, so I'm going to move quickly. First, we have volatility, the VIX index. Look here, we are at those pre-COVID lows. We're staying there. The market is down. I don't know if you caught the news last week, the breathless financial media that I talked about in the Robinson Report video, but there was so much hand-wringing. We had 9 consecutive weeks of gains in the stock market. S&P, Nasdaq, and the Dow all went up 9 weeks in a row. I haven't seen it in a long time. They all went up. All 3 of them went up for 9 consecutive weeks. Something you don't see very often, right? And then last week, we had the first down week in 10 weeks, okay? So you had 9 consecutive weekly gains, and everybody was like, oh, wow, the market. And then on week 10, when it comes down, which is totally normal. I mean, nothing goes straight up. But it comes down for 1 week, and the hand-wringing begins. Is this over? Is this over? Is the Great Depression next? They all just start hand-wringing and clutching the pearls as if, oh, no, Look, if you have 9 consecutive weekly gains, you should expect a weekly decline, maybe 2, maybe 4, huh? It's not unusual to go up and then down. So it's almost like these guys they wake up every day and it's like Groundhog Day or something like that. They don't learn, but whatever. So anyway, take a look at this. You are here. This is a gut check and reality check here. This is where we were back in 2007, the peak. And I've told you this a couple of times that during the scary moments of the market, like in 2008 and 2009, our trend system, I'm so proud of it because it calls those long-term uptrends and it's agnostic to anybody's opinion. One of the big phrases we have around here at Follow the Money is that we don't trade opinions. We trade trends, not opinions. So the trend is really what's your friend. It's not the opinion. And if you're looking for opinions, they're a dime a dozen and they may be wrong. The trend is really what you want to focus on. And so every time we've had these great pullbacks, it's been a wonderful, wonderful opportunity to add, right? To add. We've lived through all of these every single time, right? Every single time. There's the 2020 crisis. And then we have, 2022. It was brutal. But had you bought, the lows or in the lows of 2022, you're happy as a clam today, right? Look where we're at now. Are we going to have another pullback? Sure. We going to have another crash? Of course. That's how the market works, so we got to know that. But overall, you can see that this thing is moving up and to the right. And until it doesn't anymore, well, why fight it? Why fight it is what I say. The S&P verging here on a brand new all-time high. 47.96 or so is where we were back in 2021. Our system called that new position uptrend in January of 2023, right after a brutal 2022. The new uptrend came, and then the long-term trend was confirmed in June of 2023. And since that time, of course, it's rallied nicely. We had that inverse head and shoulders, which was a very bullish signal all through 2022. It formed this head and shoulders inverse, right? And then it rallied. There's the 97 and the 351. There's the crossover in May, June, right in there in 2023, confirming that this inverse head and shoulders was indeed real and that it was bullish. So we came up, came back down a little bit, held 351, and then rallied even higher. So when you look at the 351 and the 97 strategy, you'll see that firmly is intact. We've had 6 of these buy signals. We gave you the last one in June. It's really worked out well since that time, albeit with some pullbacks along the way, as we all expect. 77% of stocks in the S&P trading above their 200-day moving average now. The breadth is really broadened out to other sectors. And the Nasdaq 100 is trading just off of its recent record high. Here's a weekly chart there. You can see we got that pullback in 2022 to that coveted 200 weekly moving average. What a gift on something as large as the Nasdaq 100, which is so diversified among non-financial companies, major companies in the U.S. What a gift to have it touch the 200 weekly for a while for accumulation purposes. And then, of course, it rallied. What a nice rally that's been. Looking at QQQ here on the daily, you can see that we kind of got out of that little funk that we had. We finally broke out, and we're on the move. above a rising 50 and a rising 200-day moving average. We invest in QQQM. I made that shift about, I don't know, 6 months or a year ago. I forget now. But I just moved out of QQQ to QQQM because it delivered the same returns, but the expense ratio was less. It was like 5 basis points less. And so far, I can't tell any discernible reason to own QQQ versus QQQM. So I just do that instead. So I own the Nasdaq 100 through that particular ETF today. The Russell 2000 also breaking out above that 198, pulling back. It's kind of loading right here. This could be a great opportunity here. It came back and filled that gap like we were talking about earlier about gaps. Jason had asked about. There's a gap right there. It rallied, it gapped up, rallied, and then came back and filled that gap, right? So now that it's filled the gap, it could begin rising again. There's small caps. The dollar also falling. Got into this 100 to 101 support zone, really important level. If it breaks down below the 100 level, or not if, but when, that's going to be really a big deal for the dollar and also for assets that are denominated in the dollar. You got plenty of resistance here. You've almost got a new death cross here with the 50 crossing the 200, maybe in the next few days. Also, you'll notice that the value of the dollar falling down to this right here, there's 100, and that coincides with the 36 monthly moving average. Boy, that's a long, long monthly moving average, as you can see there. You know, it looks like it's finding support there, but a breakdown would also coincide with that 100 level. Right there, as you can see, that 100 to 100 level support range, it's fighting to hold that area. A breakdown there will be, you know, obviously bearish. We're not even in oversold territory yet for the dollar. The dollar would have to fall probably to about 97, 98 to really get into this oversold zone. That's when you start to worry a little bit that it could rebound, you know, in a significant way. But here we don't expect a big rebound. The 10-year Treasury also back at 4%, 4.01 as of yesterday. But again, that's right below that 200 daily moving average, as you can see here, and that seems to be acting as resistance. You also have the 50 coming down as well, so we may get a death cross there, like the dollar is trying to do as well. So we suspect that this rally here is going to be short-term phenomenon. Plus, we have inflation numbers coming out on Thursday, the CPI for December. We have PPI coming out on Friday. Those numbers will either raise this or lower this. We do believe that those numbers will come in not as hot. We think they'll come in pretty low, relatively low, and it should take some more pressure off of these yields. That's our hope anyway.